Welcome to the Wade Borth Podcast. I'm Wade Borth, your wealth strategist, and today I have a friend of mine, David Babinski. Welcome, David.
Hey, Wade. Great to be here.
Glad to have you. So, in my previous podcast, David, I've talked about what I call the three wealth destroyers. That being inflation, fees, and most importantly, taxes. And a lot of people I hear is like, well, what can I do about taxes? And they think the only thing they can do is to defer their taxes. And the reason why I have you on, and the reason why I think it's going to be a great conversation today, is that you have a solution to people's tax problems, either mistakes they've made in the past, which may be deferring taxes, or if they're in a high enough tax bracket to maybe eliminate having to pay those taxes today. So, David, would you just want to tell us a little bit about yourself and kind of your company, True North Resources?
Yeah, absolutely, Wade. Thanks again. So True North specializes in real estate investment that offers some tax savings opportunities. So we really work in the high income earning side of the financial services market, working with people that are in those highest tax brackets, that are in high tax states. But on top of that, we also have developed some strategies to do some advanced planning. So you could look at what your income might look like in the future and talk about tax diversification, right? I'm sure that you've already probably covered this, or if not, real quick, when you save or invest money, you could really do that in three different ways, right? It could be taxed now, it could be postponed, or they like to use the word deferred, or it could be taxed never. And there are those couple of tools that we now have access to for just about everyone, where you can start to build up that taxed never bucket, which most people don't even think about their investments in that, in that type of a context.
Right. I like the tax never strategy. I think that's a great strategy.
Yep.
So, because as people are indoctrinated to think that there's just one way to skin a cat, and I've heard it said there's a CPA out there that talks about the tax code, and in there he calls the tax code is your roadmap to discovering how not to pay taxes, right?
Absolutely.
By just understanding and learning the tax code and understanding what the government wants, because the government is wanting us, they're enticing our behavior by putting tax code out there. So we're not doing anything that's strange or unusual. We're just taking advantage of what the IRS has put in the tax code to take advantage of, again, the behavior they want to eliminate our tax problems.
No, wait, you're exactly right. I mean, the tax code is a series of incentives that the government has laid out in front of us and incentivize us to act in certain ways. So if you're paying taxes, that means that you're not developing real estate, which is highly incentivized. You're not donating to charity, which is highly incentivized. You're not improving your business or property. So it's just a matter of taking a look at the incentives that are available and matching them up to the correct scenarios, right? You don't just run out and do these things. It takes a little bit of planning. It takes a little bit of knowledge. But really, utilize to its full advantage, you could really reduce somebody's taxes.
Correct. And for those people that have been out there thinking that deferral, again, we can talk about deferral. Maybe I'll do that right now. Because when I first got started in the business, it was all about how do we, HR 10 plans, the plans that deferred our taxes. And we thought that was a strategy that solved our problem. But really what it did is it delayed our problem. And it really now, especially in today's environment where we're looking at, billions of dollars being pumped into the economy by the federal government, that tax bill eventually will come due, will it not?
Right. And I think you meant to say trillions, because I thought I heard you say billions.
I'm sorry. Small minor error, just one.
Yeah. Just a zero.
Yeah.
Just a zero or two. But yeah, I remember I was listening to an interview, one of these C-SPAN things, and the senators were kind of talking off mic, and it was picking it up, and the quote goes something to the effect of, a billion here and a billion there. Before you know it, we're talking about real money.
Right.
Right. And now it's a trillion is the point. That's what we're talking about. But, getting back to the tax deferred retirement account, in 1972, when ERISA came out and became popular, what you have to realize is that in the entirety of the 70s, the highest tax bracket happened to be 70%, right? 1970 was 71.75%. So think about this. It made a ridiculous amount of sense that, hey, I've got $1, 30 cents is going in my pocket and 70 cents is going to the government. Now I have a way to keep that dollar, grow it as I see fit, and then defer those taxes to sometime in the future. I'll take that deal every day of the week. Because, $2 is going to the government for every dollar I keep. Well, let me keep my $3. I double it. And then I might owe them, $3, but I have a lot more. Now, fast forward, through the Reagan years and how tax code has changed. Now our highest tax bracket, of course, is 37%, with the surcharges. So let's just say, the highest tax brackets that we're seeing, with the clients that come in the door, 35, 37, and then potentially another 2. Doesn't make as much sense now to put that dollar away, grow it, and now owe the government taxes on the future tax rate that could easily be back to 70. So one of the tools we use is the Roth IRA, and I know you wanted to get to that. But yeah, just keep in mind when these deferred retirement accounts came out, 401k is a popular section of the tax code that people rattle off their tongue, maybe not even realizing that you're referring to a particular line in the tax code. But when that came out, the highest marginal tax rates were 70%, 69%, 50% in the 80s. Now we're at 37.
Yeah. Now at 37, and then people are encouraged and almost forced to believe that not paying it at the current tax rate is going to be better than something in the future. And I don't know how anybody looks at this and goes, it's going to be worse in the future from a tax rate. So the question is, what do we have for a solution?
Right. And I think there's 3 or 4 main ways that we see people saving in that taxed never bucket. And, the most popular and what we see people go towards first is the Roth IRA. Now, I've had many CPAs and many clients say to me, oh, my CPA says I make too much, I don't qualify for a Roth. And as much as that on the surface is an absolutely true statement, the industry has figured out ways, and the tax code does allow for just about anyone to get access to a Roth, either through a conversion. See, there used to be a way to take your IRA, your 401k, traditional, and convert it to a Roth. Then they put a limit. Oh, if you make too much money, you can't do the conversion. That's now changed. Anyone can convert traditional IRA to a Roth IRA. Now, also, depending on if you have participation in your company's plan, anyone can make an IRA contribution. It may or may not be deductible. So I'm going to go out on a limb and say, in just about any scenario, you can put money into some type of a deductible IRA and then convert it to a Roth IRA, and you end up in the same position that you would have been in if you had access to a direct Roth contribution. But then the bigger part is the conversions, taking money that's already been sitting there, that's already growing, and converting it into a Roth. It's a taxable event in the year that you do it for the amount that you do. You don't have to do it all, but it's a taxable amount in that year. But then it's going to grow tax deferred until you take it, and tax free as long as you follow some very simple rules, 59.5, and a couple of other little minor things on the growth. So that's the Roth IRA, and that is kind of where most people start accumulating that taxed never bucket.
Yeah, and you made a point too that those dollars, when you do take them from the IRA to the Roth, have a taxable event, and that's really where you guys specialize, and that's your kind of your sweet spot. Your where you guys specialize in, say, how do we reduce that or mitigate some of that tax liability? Is that correct?
Yeah, that's right. So again, when I said, we really specialize in working with folks in the highest tax brackets for some of our advanced strategies. And where is that these days? I'll just cover it quickly, because you need to know these numbers if you're going to start converting to a Roth IRA at any income level. But if you're single and you're earning above $163,000, you're getting into the 32% tax bracket. $207,000, you're getting into the 35% tax bracket, and then over 518 is the 37. Now, for a married couple, you really get into those higher tax brackets at $326,000. Now, if you're listening to the podcast and you're saying, but I'm lower than that, what kind of strategy can I use? Well, there's a strategy called, kind of bracket stuffing. I don't know if you've heard of this, but, basically if you're married, filing joint, and you're earning less than the $171,050, which pushes you from 24 to 32%. Well, why don't you take whatever the difference is? Say you're at 100,000. Well, you've got $71,050 that you could show as additional income and still be in the 24% tax bracket. So there's a little bit of finesse involved, but there's really a mathematical calculation you could do every year to say, hey, why don't I take some of this IRA money that maybe I did get a deduction when I was in a much higher tax bracket, or it's at least growing and it's going to grow into a higher tax bracket in the future. Why don't I take some of that IRA money now and fill up that 24% bracket or fill up that 22% bracket? And then, like I said, once you get above that 32% bracket, we've got other strategies on the tax return for different deductions and different ways that make sense. The math makes sense to do those strategies, but you really need to be in those highest three tax brackets for our advanced strategies.
Correct. And just so everybody doesn't try to write those numbers down and get it all, on my website, sagewealthstrategy.com, we'll have a link to a number of examples that David's laid out, and just to see how this could actually work as an example. We'll put some videos out there for you to take a look at. So again, we'll have it on Sage Wealth Strategy, and then we'll have a link to David's company website, truenorthresources.net. Again, that's truenorthresources.net. So again, the links will be on sagewealthstrategy.com, and take a look at it, and we can see. So you don't have to remember the numbers, but more importantly, today it's just having an understanding that there is a solution, because I talk to a lot of clients thinking there's no solution to the fact that they have. Again, I'll use your example. I have a client that's married couple that makes about $200,000 per year. They feel like they're kind of stuck in the sense that they say, well, we have to take the 401k that's there because we have to reduce our taxes. And then when we started talking about the money that they have in their IRAs and their 401ks, he understands he needs to move to a Roth, but he just didn't know that there's a strategy. So by having the conversation with him, like, there is a strategy where we can, like you said, take and stuff the brackets, because he's a firm believer, I'm a firm believer, and I imagine you do too, that the tax brackets we're in today may be the lowest we're ever going to see in our lifetime.
Well, Wade, as much as it's a philosophical discussion, for the first time in my career, I could definitively say, by tax code in 2026, the rates are going up, right? So we don't even have to guess. I mean, intuitively, we all know trillions of dollars onto the Fed's balance sheet. Someone's going to have to pay for this, right? So we know that intuitively, but put that to the side. The current tax code, when the Tax Cuts and Jobs Act was passed in 2027, it reverts back to those old tax rates, which is important to know. But more importantly, it reverts back to the amount in each bracket. What do I mean by that? Like, you've got to be over 622,000 to be in the highest tax bracket, married filing joint right now. When it reverts back, people say, 37% to 39.6, it's not that much. But the 39.6 kicks in way lower. So you're going to be in those higher tax brackets way quicker. So yes, I do believe taxes are going up. Why? It's right in the code. If Congress does nothing, which they're really good at, right, tax rates are going up in 2026. That's already part of our code. It reverts back to those old rates. The TGCA, the Tax Act in 2017, was only a temporary. Now, we're not going to get started on this. The changes for the corporate side are all permanent. But for the individuals, we're reverting back in 2026. So let's just plan for it. Let's put a strategy together between now and the tax year 2025. Let's convert money into Roth. Let's look at an HSA. You could probably cover that on another podcast. Yep. Let's look at permanent life insurance. Let's look at the things that are tax-free forever and start building those while rates are historically low.
Correct. And so one of the things we talked about in previous podcasts, and I mentioned this earlier, was the three wealth destroyers, right? One being taxation. We've talked about that. The other one's inflation. Just wage inflation when you mention this, the fact that they're going to revert back to the same rates at the same level, the wage inflation, which doesn't necessarily mean we have more money to spend, but just we have more money, now it's going to be taxed at a higher rate. So that's, again, inflation's kind of that insidious killer in our wealth building strategies that we have to kind of take account for. And you made a great point saying that just because of if we're in the same job and we got our 3% raise or 5% raise over that time frame in 2025, when they revert back, that's going to make a huge impact on what our tax brackets or what our tax liability is going to be.
Right, because you're going through those brackets. And here's the other thing. I was, for about 15 years of my career, I was advising folks that were already retired. So I'm working with people who are either transitioning into retirement or retirement. And what a lot of folks don't realize is that if you're married filing joint, you're at a certain bracket at a certain amount of income. But if you're single, it quite literally gets cut in half, meaning for the same amount of income. So I had a client, the husband had passed away. For the same amount of income, as a matter of fact, it went down slightly because you lose the smaller Social Security, but the pension continued. They had good income. They owed, the widow owed like an extra $18,000 for the same amount of income. Because why? Because you're jumping up those brackets that much quicker as a single person. So, there's a lot of little tax traps that just a little bit of planning, you can account for that, so that as the income's coming in retirement, as you're doing major purchases in your life, you're looking at these factors and taking that into account.
Right. So just a little bit of strategy while we're here, we're in the environment we're in, because we can't change that environment. So take advantage of the current environment we have. We have a number of strategies of if you have high income, to help wash or to eliminate some of the tax liability that's out there through strategies that are already laid out in the tax code. So we're not creating anything. But more importantly, for those that have 401ks or IRAs or tax qualified plans that they said, I would love to be able to wash the taxes off this thing, move it to a Roth, have it grow, or, move it to another strategy so we have a tax-free bucket. There are ways to, if not completely eliminate, at least mitigate some of those tax liabilities and wash that tax liability from our money. So when it comes to retirement, we're able to do a better job of saying, hey, I know what I have for dollars and I can spend that. I'm not going to have to worry about Uncle Sam coming and taking a large portion of that.
That's right, Wade. We finish up with the concept of tax diversification, right? Everyone's heard of diversification. I've got some money, in the stock market. I've got some money in bonds. Even inside the stock market, I've got some international. I've got some tech. So diversification is but nobody talks about tax diversification, having access to some tax-free sources of capital in retirement makes a huge difference. So just that's the conversation that I invite people to start to have. How do I start to, you don't have to do it all, but some type of diversified between the three buckets we talked about.
Sure. And like I said, we'll post some examples, some videos that David's done for us on sagewealthstrategy.com. And we'll also have a link to True North resources on this podcast. So take a look at what he has to offer. Give me a call, drop an email to Wade at Sagewealth Strategy, and we'll see if your situation, if David can help your situation from a tax standpoint of either converting your existing taxable bucket, all taxable bucket, to a tax-free bucket, a never tax bucket. And we'll see if that works, and we'll get you hooked up with David if that strategy looks like it could work for you. So once again, thanks, David. I appreciate your time.
Oh, it's great being here. Thanks, Wade.
And just throw out real quick, what's your website so I don't butcher it?
Oh, it's pretty easy. True North Resources, plural, truenorthresources.net. So that's where people get caught up. It's got to be .net. And I'm sure you'll have a link in yours. Different than yours. Yours is strategy, right? It's singular, where ours is True North Resources, plural. So
correct.
Gets a little confusing.
Yep. Sounds good. So, well, I appreciate your time, David, and I imagine we'll have you back on again. Thanks so much.
Anytime. Thanks.